next guest, Bill Baruch, joins us. President of Blue Line Futures is here with us to talk commodities and eco data. Bill, welcome. Your thoughts on this jobless number? Should we be concerned? Indices don't seem to be so much. 192,000 weekly jobless claims below consensus.
Yeah, it's just hanging right around 200, 10,000 here, 10,000 there. It hasn't really moved in either direction. I would expect that we start to see this job market, loosen up a little bit, and we start to see maybe this get above 200 or unemployment move back above 4%. I mean, we saw that in the jobs report last week, unemployment getting to 3.6%. It's just going to take some time. The Fed has been slowly trying to break things. We saw some things in the bank start to break. The Philly Fed was a big whiff. I think it was minus 22. That's on the heels of New York, Empire State. Yesterday was another big whiff. Those are fresh February numbers too. So we're starting to see some poor data. But go back to yesterday. We had the really soft PPI. Retail sales fell out. Very bad New York Empire, and the stock market sort of sold off after initial spike. So, I mean, do we really want to see the economy falling apart? Yeah. And I think that's actually a good thing right now. I think we really just jumped right over it, where we need to see data slowing. As long as inflation's slowing, we don't need to see the economy falling apart. We don't need to see the job market just in shatters. I think, is a good point there, right? We don't necessarily want to see the labor conditions crater here in the U.S. I think what we want to see is wages kind of hold, right, and not necessarily see them on a wage spiral here ultimately. But we do want to see strong labor conditions as the economy stomachs and pushes through a higher rate environment. Yeah, I think we got to sort of muscle through this environment. I think that the Fed's work has begun to start to show. Yeah. And that's we've had that bounce back. It's what we've called the social evolution between Thanksgiving and Christmas. I'll spare explaining it. I've been talking about this for a couple months now. But we had that bounce back in January. You don't know how long it lasts, but the slowing that we had in quarter 4 was more of the social evolution, not the Fed. And now we're starting to see the Fed slowing really start to come to work here. I think just a matter of patience, and sure. The Fed has some time being lended here with what's been going on in the banking sector. So, it backs Powell's off from the 50 basis points. It's leaning right now before this number. It's about 70% chance that we saw that they'll move 25. But still, even if they move 25, you're looking at by September, after post 25 hike next week, you're seeing in September would be 75 basis points worth of cuts, 100 by December. So we're starting to see the cuts being priced back in, and that's my new theme here is looking at that, extrapolating, bring out your 2019 playbook. Bill, I think patience is a good word when you you could describe markets in terms of they're being patient right now. The S&P is in the middle of the range that we established since May of last year. I pointed out at the beginning of the last block, the dollar's in the middle of the range that we established last year ultimately. So markets are waiting for more information, and along those lines, we're getting more information here, and it is kind of trickling through. So we have to be a little bit patient. But, many are scratching their head in terms of some of the layoffs we've been hearing about, not necessarily equating to job loss. But let's talk, because you mentioned packages that are going to take a few months to get through. I mean, you can see a 6-month severance package, and they're not going to be showing up in the labor market yet. Noted. And again, we talked the weekly, the more high frequency data, not getting too attached to that. But you mentioned the Empire State manufacturing data, and if we could pull that graphic up again in terms of the Philly Fed, I mean, that came in a little bit weak here again today, and a sign in terms of what you're talking about, the Fed trying to break something here, and it seems like they're at the very least slowing things. Yeah. I mean, things are slowing. Now, Atlanta Fed GDP now yesterday said 3.2% from 2.6. So we're seeing this is something. It's not new. The data is lumpy. It's distorted. It's not as surprising. I think the biggest takeaway from this week is that even though CPI was in line with expectations, it was slower than we saw in January. Mm-hmm. And then you look at the Cleveland Fed models, we're expected to see it continue to slow for March. And then PPI, I mean, that was really under expectations. Not only that, they revised January quite a bit lower. We saw some just disinflationary effects in the headline number of PPI. And then, producer prices are leading indicator to consumer prices. That's the big takeaway this week as moving to the Fed. That and coupled with obviously what's going on in the banking space is going to really, get Powell's back off the wall here, and it buys him some time. It gives him some patience as well to kind of watch everything percolate through the market. What they've done, I mean, they raised what was it, four 75 basis point hikes in a row last year. I mean, it's just so quick. It really hasn't been able to work through the market yet.
Bill, I'd imagine crude to 65 this week provides Powell a little bit of breathing room as well.
Yeah. I mean, that break of 70 is pretty big. I've been saying this for a while. You know, crude oil is in a bull market above 70. It's in a bear market below 50, and between 50 and 70, you have vicious volatility. And so we had a little level at 66 to 66, a little, sort of ironic. I was looking at it at that point. It kind of held yesterday, but there's a big trend line if you go back to 2016 and you leave out the pandemic. I'm actually sending it out to clients. I got a whole chart book this morning. If you sign up on our site, bluelinefutures.com, you can get our whole chart book. I'm going to send it out after this spot, but I have the crude on there, some gold, some copper gold ratios, some really interesting stuff. But that crude chart is I think something very important to note right here. Breaking 70 breaks this long-term trend line, and then you put this in this vicious volatility cycle. I wouldn't be surprised to see a little snapback. I actually was looking for a little bit of snapback here, trying to find some value in a very cheap call spread in order to see that here in the next week or two.
Crude, a vicious breach of the 50-day moving average after a test above it in the beginning of this month. Let's pull this graphic up so you can see again the chart and the weakness we've seen. Crude lower again this morning, currently trading down by about 0.25%. But yeah, definitely under pressure. And let's just take a longer-term look at crude here. You can see again from that trend line you were talking about, going back to those pandemic lows around 650 and the breach of here. You can see again some of the weakness that we've seen, the significance of the $70 level. And Bill, appreciate you joining us, sharing part of your Thursday morning to help us talk commodities here. Take a look at some of the eco data. And Bill Baruch, the president of Blue Line Futures, you can check them out there. And now